chapter, right? The first module spans chapters 1 and 2. We're ready to start with the next chapter. Does anyone have any questions at this point? Chapter 1 is primarily, it sets the tone for the rest of the course. There's not a lot in chapter 1 that is specifically examinable. For example, the lessons of 2007, 2008 crisis, that's not really examinable. The basic ideas about what information asymmetry is and so on, yeah, you should have some awareness, but the actual examination will be more in terms of the application, not so much of do I need to memorize definitions. Because your quiz, you're going to write from home, so that means the quizzes are all open book, right? So you will be able to look up your material. So if I ask you for specific definitions, that's more or less an easy question to ask. So don't worry about memorizing everything. Exams will be open book. You need to be able to apply the concept. Does anyone have any question or comment at this point?
Hey, Dr. Diol, I have a questions about the quiz.
Yeah, Bernard?
So is the quiz will be more about case based or is it like, being able to apply what we have learned in class? Sorry, I'm kind of mixed up here.
So cases are in a way application, right?
Right. Yes.
Yeah. So there may be there may be shorter descriptive questions, or there so when we talk about cases, sometimes we think, oh my God, a case is where it's 2, 3, 4 pages long and we have to read and we have to fix. Not necessarily. You can have cases that are short and very direct as well. You're given some facts and you're asked to either explain why this happened with reference to the theory and so on. So we'll be doing some examples. The textbook has end of chapter examples of such types of questions. You will have some of those. And in chapter 2, accounting under ideal conditions, as well as chapter 3, the decision chapter, there are some calculations as well that we'll learn to perform. So the quiz could have those types of calculation questions.
Sounds good. Thank you so much. Appreciate it.
Yeah, no problem. Sorry, Benjamin, are you talking? You're on mute, I guess. I'm sorry, I still can't hear you. Was that only me or were the others able to hear Benjamin?
I couldn't also hear him.
Yeah, seems to be an issue with the mic. If you like, Benjamin, you can type in your question in the chat box. All right, here's what I propose.
Here's what I propose.
Okay, I could hear my
I could hear
echo.
my echo.
All right, let's do one thing. Benjamin, you type in your question in the chat box. The rest, let's go for a break. Okay, so it's 7:52 as per the clock. Let's come back a little after 8. And so the plan is we will go all the way till about 8:35, 8:40, no more than that. Okay, in the meantime, Benjamin, once you've typed in the question, when we come back, I will address your question and then we will start with chapter 2. All right. Okay, I'm going to pause this recording and look forward to see you in just about 8 to 10 minutes time. Zoom. And before we went for our break, I'd asked Benjamin to type in his answer, rather his question, and his questions related to the dates that we were talking about for the evolution of accounting standards. So yeah, so Benjamin, the short answer is this is not a course on accounting history, so you don't need to memorize any of those dates. That was just to give you context of how accounting has changed, or good word is evolved over time. You're not responsible for memorizing any of those dates. It would, from chapter 1, if there's anything that I would expect to know, it'll be the concept of information asymmetry and the fundamental problem of accounting, right? How do we address the dual needs for providing information that the investors will find useful, and at the same point in time be able to assess um, whether management has done a decent job of stewarding the resources that have been entrusted to them, and how this fundamental problem is linked to information asymmetry. Okay, so that part is probably the application. Okay, any other question before we start chapter 2? All right, it's time for us to then move on to chapter 2. And chapter 2 talks about accounting under ideal conditions. Ideal conditions are essentially if there was the proverbial Garden of Eden or utopia, what would accounting look like in that case? So we will be looking at what the meaning of ideal conditions is. And then we will see that under ideal conditions, accounting is done pretty much through the application of the present value model. And we will look at its application in 2 scenarios: ideal conditions of certainty and ideal conditions with a degree of uncertainty thrown in. And then we would look at an example of the application of this notion of ideal conditions. And we have 2 examples here. One is with regards to reserve recognition accounting in the oil and gas world. And then the second one is the concept of embedded value, which comes from the world of insurance rather. We will wrap up with a discussion of comparison of historical cost accounting with current value accounting, fair value, if you will, and wrap up with a discussion of how true net income does not exist except when you have ideal conditions apply. And ideal conditions, by definition, don't really exist. So the notion of a true net income is a chimera for most of us. So as accountants, we say, oh, as accountants, we prepare financial statements. And one of those financial statements is the income statement, which talks about net income. Well, I've got news for you. As far as accounting theory is concerned, that net income number that we prepare as accountants and report to outsiders is not really the true net income, because we cannot achieve that particular calculation. So whatever number we come up with is an approximation. And it's not rocket science to figure out why. There's a lot of assumptions and estimates that go into the calculation of that net income. And because of such estimates, the number is an approximation of what net income might be, but it's not a definitive answer. So start out with what is meant by ideal conditions. So ideal conditions are said to exist when market value of an asset equals the present value of all future cash. You've learned of present value in your finance course, or in the intermediate accounting courses, you've learned how to calculate PV. You specify the cash flows that are expected to occur in the future, and then you calculate a present value by using a discount rate, the I by Y. So under ideal conditions only will you find the present value of future cash flow streams equal market value. So why do we say that? The reason for that is we assume that we know what the future cash flows are. And say if such future cash flows are probabilistic, we know what those probabilities are. So knowing the probabilities of future cash flows means we are able to calculate the expected value of future cash flows. And that's just nothing but a probability adjusted weighted average. We also assume that markets are perfect. Now that is an assumption from microeconomics. Markets are perfect, which means no single individual can impact the market prices. There's no single party that has so much power so as to affect the market rates of return. We also assume that the markets are complete. So there's no seepage out, there is no wastage in any form, there's no friction, and that the markets are efficient. And we will be exploring these notions in more greater detail in chapter 4, but suffice it to say that the market participants, they actively seek out new information, and as soon as new information becomes available, the market participants, their actions, their buy-sell responses to the new information results in a market price that is reflective of the new information. So that means, again, there is no way for any single individual to beat the market return. In microeconomics, you might remember, in a perfectly competitive market, people are price takers. No one can actually dictate prices to others. The suppliers are price takers, the buyers are price takers. No one has enough power to influence the market price. That notion is borrowed from microeconomics here, that we have markets that are perfect, they're complete, they're efficient. There's no information asymmetry. No one party has an informational advantage over the other. Now, these are admittedly, when you read this, when you see this on the screen, I'm sure some of you are quietly chuckling and go, okay, and pigs will fly. And I'll agree. Look, you need a starting point, right? What would utopia be like? We know that real life is not a utopia. We know that real life is not ideal. We know real life is messy. Okay. Well, we need a starting point, right? We need a starting point. So this is if we did have conditions which would be perfect. Well, what would accounting look like in that situation? And then from there, our parable will then devolve into why we do not live in utopia. What are the reasons? So you can start poking holes right here. When I say, oh, under ideal conditions, my friends, future cash flows and their probabilities are known. You can counter and say, Harjinder, in real life, future cash flows are often not known, or even if we know what the future cash flows might be, we cannot say for sure what the probabilities of those future cash flows are. If I say markets are perfect, complete, and efficient, you would say in real life, markets are not perfect, they are incomplete, and they are very often not highly efficient, right? There are areas of friction that exist in the market. We talk about there is no information asymmetry, and you say in real life there's no such thing. There are people that have an informational advantage over other parties, right? So we know, yes, reality is murky, reality is messy. So this one is chapter 2, what you're picking up in chapter 2. Please take it up with that huge dollop of salt. We do not live in a perfect world, but if the world was perfect, then in a nutshell, I'll tell you, we would really need accounting. There would be no need for accounting. There, I've said it. In ideal conditions, no one would need accounting. The very fact that accounting exists, we have those jobs out there, is because we do not live under ideal conditions. Right? Accountants help bridge the chasm that is created by less than ideal in terms of access to information and pertinent information that's required for the kind of decisions that people have. The fourth assumption is that the discount rate is given and is constant. The constancy part, right? Certainly we have the notion of credit adjusted risk. We know of people, they have different credit scores. So for someone, let's say, who has a credit score of 850 and another person that has a credit score of 650, if they go looking for a loan from a bank, the person with the lower credit score, A, might not qualify for the loan, or if they did qualify for the loan, they might actually have to pay a higher interest rate than the person with the better credit score, right? So discount rates are essentially the rates that lenders charge for money or investors charge as a rate of return for making the investment. And that is never constant, right? So we know there are reasons why conditions are not ideal. Here, in an idealized world, in a perfect world, all these assumptions would be valid. If they are valid, then what? The implication is that you have no friction at all, so assets and liabilities are valued based on expected present value of future cash flows. That's the notion of value in use that you would have picked up in impairment testing for IFRS. And accounting is just a simple matter of amortizing any discount that arises due to the PV calculation. So how do we apply the present value model under certainty? The calculations, when you have ideal conditions, so ideal conditions, again, future cash flows are known. And when you have certainty, there's no probabilities involved. So that's out. Markets are perfect, no information asymmetry, discount rate is given and it's constant. Well, in that case, what you do is you determine the initial investment, which is just going to be the simple present value of future cash flows. Every year, you calculate net income, which is nothing but the accretion of the interest. And the balance sheet is basically, your amortization schedule for a bond that you've learned about. Right? Cash comes in, the bond liability or the investment goes down, and you will find that the duality is maintained. Asset equals liability and equity. Deal conditions under certainty. We still assume that the discount rate is fixed and it does not discriminate amongst different sources of capital. So that is still very much an unrealistic assumption. However, because we are now incorporating uncertainty, we're saying we don't know for sure what exactly the future cash flow is going to be. Right? So that part is uncertain. That being said, we have the ability to describe what the future states of nature might be. States of nature are, think of it as circumstances. So if cash flows in the future depend on what the circumstances are going to be, right? Think about the economy doing really strong, really well, as opposed to an economy that's in a recession, as opposed to an economy that's kind of middling it, etc. The assumption that we make is, since we are still under ideal conditions, we are able to describe what the future conditions might be, what are the various future states of nature that could occur. And we also know what the probabilities associated with each state of nature are. So, is there a 30% probability that next year there's going to be a recession, or 40% probability that next year is going to be a boom time, et cetera, et cetera. Each state of nature, each set of circumstances in the future, we have objective probabilities. Objective meaning they don't depend on an individual. These are probabilities generated through masses of data. And what actually happens is capable of being known to everyone. It's publicly observable. So no one can be hoodwinked into believing that the state of the economy is something that it actually is not. Right? So these are still very powerful assumptions in the form of knowledge that people have, right? That people do not suffer from any kind of limitations in their ability to predict the future, that people are able to predict future with ease. And whatever does happen, people are able to um, to observe what's taking place. So in terms of news, the news about the economy and what's going on is very rapidly disseminated. So no one suffers from any kind of lag of knowledge. And another assumption that we're making, I would say implicit to all of this, is that people have the ability as well as the time, right, to be knowledgeable about these issues. Now, in real life, these are the very instances where things fall apart, right? So I might have money to invest, but I might be so busy because I'm doing other things that even if I am financially savvy, I just don't have the time, right? And so that is the reason why I have to entrust my money to somebody else. And then once they've got my money to invest, if they're not able to do a good job, the investor, the fund manager can turn around and blame that poor performance on a whole slew of things that might not actually be the real reason for the poor performance, right? And that's the whole point of information asymmetry that we talked about last class. Information asymmetry is a reality of life, that people don't have access to the same amount or same quality of information, or at the same time as other people who might be in the know have. And that is why we get the absence of trust, which is the sole reason that accounting as a discipline exists for many people out there. So a little bit more about states of nature. I've alluded to this being these conditions in the future, the circumstances in the future on which future cash flows depend. And these, in your textbook examples, these would include stuff like, oh, how was the weather? Was the weather, was the weather good or bad? Or it could just be the state of the economy, as I mentioned. Did we have a boom time, or was the economy in a recession? And then you can have varying degrees of such states of nature too, right? In terms of agriculture, did we have a good rains, or did we have a really dry spell? Because dry spells would be not so good as far as crops are concerned. These state probabilities relate to what the chances are that a certain state of nature will occur in the future. So we don't know exactly if next year there's going to be a recession, right? Even in our context, you might have, if you're paying attention to the business press, there's talk about how there's a likelihood that our economy might go into recession. And the rationale is that the central banks have been raising interest rates to tame inflation, to bring inflation rates down. And inflation has been quite persistent. And so the central bankers have been continuing to raise interest rates, and it's still expected that they'll do so yet more. And the result of the increase of the interest rates has been that the cost of capital for companies has been going up, especially for companies that are quote unquote in the growth sector, so information technology companies. And for them, with interest rates going up, their access to capital will shrink quite a bit. Interest rates also serve as an input for the discount rate that investors use when determining whether they want to make an investment or not. So with interest rates going up, keep in mind that any investment in shares has to be pulled away from the safer investments in bonds and fixed securities. So when you have interest rates going up, the result is that the yields on bond investments, fixed income securities also goes up. And for a person that has money, if they can, if you've been paying attention again, you are able to buy a GIC, a guaranteed investment certificate, paying 5%, 5.5% interest. So if someone has money, let's say if I have $100,000, I can put my $100,000 in a GIC that pays me 5.5% interest. My money is safe. There is no chance whatsoever that I would lose any of my capital, any of my $100,000 principal, and I will also be able to earn a nice 5.5% interest on it. So why would I even consider investing that $100,000 in shares? Shares are by definition risky. So the only reason that I would even consider investing in shares is if the investment in shares offered me a potential rate of return that was significantly higher than the 5.5% interest rate that I can get on. That's called the market risk premium, right? For an investor to pull funds out of fixed income and park it into equity, the expected rate of return needs to be higher. And with shares, the rates of return act as discounting factors. So when expected or required rates of return go up, stock prices go down, right? And that too, for a person who's, say, very concerned about the possible loss arising from drop in stock prices, that would act as a dampener. So it's kind of becomes almost a snowball sort of issue. So yes, investors will require a higher rate of return, but the higher rate of return would mean that the stock prices have to go down. And if stock prices go down too fast, too quickly, people might again be scared off of the stock markets and etc. So all of these can have very, very, very complicated outcomes for securities markets. Under ideal conditions, we are making these assumptions that not only is the discount rate not dependent on the type of security, but that people are able to define and describe all the future conditions, circumstances that might exist that'll have a bearing on the cash flows for the company, but also that they're able to come up with probabilities about those future circumstances that are not really dependent on somebody's gut feel. They're not subjective, they are objective probabilities. These are very, 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 I would say, simplifying assumptions that will never hold scrutiny in real life. Now, these probabilities, again, in reality, could be objective or they could be subjective, but we make the assumption that under ideal conditions, these probabilities are objective. They are based on fact. They are calculated on some scientific basis. The third assumption is that what happens in reality is publicly observable, that there is no lack of, so there's a complete absence of any kind of opacity. There's basically complete transparency with regards to what happens. We do not have to worry about anyone being blindsided about what happened. Everybody knows what happened, right? Actual occurrence is not hidden from anyone. So that means there is no information asymmetry, and information asymmetry is ultimately the beast that that needs to be tamed. Information asymmetry, again, as a reminder, we are talking about the situation where the information that is available to one party is different from what is available to another party to a contract. If one party knows more about the facts than the other counterpart, or they happen to get to know about things sooner than the other party, they have an obvious advantage over the other, be it in terms of timing or in terms of just the quality of the information that they have. They can therefore take steps to protect their own interests. People are, we assume, self-interested. And so they will take actions that will enhance and protect their own interests, at times even to the detriment of the other party's interest. And that is where the trust gap is created and often is widened in society. So information asymmetry, we talked about it last class, can be of two types: adverse selection and moral hazard. Adverse selection is where one party has better access to information. Moral hazard is the other part, where once a course of action has been decided, one of the parties can, just because they are able to observe what's happening, they can engage in transactions, or they can do things that may end up hurting the other. Okay, and I'll talk about specific examples when they're appropriate. At this point, I'm just going to leave it at a high level. From the world of insurance, the example would be, so personally, I'm diabetic, right? So for a person living with diabetes, their expected length of life tends to be shorter than, say, everybody, for another person with the same set of situational factors and not being diabetic. So if I now am concerned about the financial well-being of my family, I would be very interested in getting a high amount of life insurance, right? So me being on the lookout to get life insurance, say I want to get a life insurance policy that pays $2 million. From the insurance company's point of view, if I don't disclose that information, if I'm able to get that insurance coverage without disclosing the information, the risk is that of adverse selection. Insurers do not want to unknowingly, or without being aware of the risk of the fact that I am diabetic, they don't want to give insurance coverage to me. They would want to make sure that they're adequately protected. So they might ask for a higher premium, or they might not be comfortable extending a $2 million policy to a person, let's say, who has severe diabetes. So that would be adverse selection. Now assume that for some reason, the insurance company did extend that policy. So now I'm covered, right? I have a $2 million insurance policy. And now, if I start not paying attention whatsoever about managing my diabetes. I am eating badly, I'm not exercising, etc. So now I'm actually taking actions which maybe in the short run is giving me pleasure. Let's say I like eating carb, and for a person living with diabetes, too much of carbohydrates is not good. But I love eating sweets, I love eating carbs, and I start going to excessive lengths doing just that. What I'm actually doing is I'm taking actions now that the insurance company can't see what I'm up to, but I am taking actions that will harm the insurance company's interest because they don't want me to die, right? They want me to continue to pay in my premiums and live for as long as possible, right? They don't want me to die. Assuming it's a 20-year term policy, as far as the insurance company is concerned, they would rather that I live for 20 years and keep paying them a premium. And on the other hand, I am now taking excessive risk because if I happen to pass away, my family will get the $2 million. So I know that sounds very morbid, but that's really my actions after getting into the insurance contract. If I take actions that are serving my interests in the short run, but it's actually acting in opposition to the insurance company's interests, that's the moral hazard part. Because the insurance company cannot observe what actions I am taking as part of the fulfillment of the insurance. And that's just an example from the world of insurance. For um, in capital markets, you could see the situation of a bank, and a company or an individual that's looking to take out a loan. The bank does not want to lend money to a person who might renege, on the contract, who might not pay back the principal as promised, or who might not be able to pay the regular interest on the bank loan. So they want to make sure that they only lend to parties that have good, strong credit. So that's in at the initial moment, that's the adverse selection issue. From the point of view of the banker, they don't want to extend credit to a person or a company that is not reliable, that is financially, not a strong prospect. Now, once the loan has been made, if now the company or the individual uses that money towards, let's say, speculating in Bitcoin or stuff like that, taking excessive amounts of risk where the potential payoff might be huge for this individual, but if things go sideways, the person or the company feels we'll just declare bankrupt. That on the up now you're dealing with moral hazard. What it is that the individual does once the contract, because the banker doesn't know what the for what purpose the amount that has been lent is being used. So if there was some kind of misrepresentation on the part of the company as to why they were raising the money and then what actions they're going to take after that, that is the distinction. First selection is before we enter into the contract. Moral hazard is after the contract has been entered into, the actions that one party takes that can't be seen by the other, which usually are in opposition to the other party's interests. Okay, hopefully that made sense. If not, we will have iterations, we will have repetition. When you are dealing with probabilities, we have to, in order to do math, in order to work around, we have to resort to some calculations. And one such calculation is expected present value or expected value. So expected value is where you take the probabilities and weight the expected cash flows, right? Weight the cash flows for the probabilities related. And since under ideal conditions, asset values are essentially reflective of the present value, PV, of future cash flows. The initial investment is calculated by figuring out the expected cash flows, which are the probability weighted numbers, and then doing a PV calculation on them. So in terms of preparing the balance sheet and the income statement, when you're operating under ideal conditions of uncertainty, just like we did for ideal conditions of certainty, we want to calculate the initial investment. Net income is the cash flow arising from what actually happened, and then we compare that to what we were expecting. Okay, so there is an element of abnormal earnings or unexpected cash flows that comes into the picture. And the balance sheet is pretty much along the lines of what we learned to do in week 1. So what's abnormal earnings? Normal earnings is defined as what we would expect based on the amount of equity that is invested. So opening equity discounted, so multiplied by whatever is our expected rate of return or discount rate. Abnormal earning part is whatever is our expected earnings, compare that to the cash flow that actually occurred. And the cash flow that occurs depends on the state of nature. So any difference between what we were expecting and the cash flow that actually occurred is captured by way of abnormal earnings. Now, risk has a big role to play in this set of affairs. So risk, as defined in finance, is the volatility. So the fact that an amount, so if this was the expected mean, right? If you are able to see the screen, if my palm, my hand here that if you're able to see my hand, if this the level of my hand represents the expected value in future, the expected cash flow, for example, actual amount could be higher or it could be lower. The fact that the actual amount could be more or less the expected value, mean value, the degree of variability from that expected value is what is defined as risk. So when we are still under ideal conditions, the amount of risk is known because we say that we are able to predict what the future states of nature are going to be. And we have probabilities related with each of those states of nature that are objectively defined, etc. But there's still a degree of variability. And that risk of volatility has to be borne by the investor. So that marks a bit of a departure from ideal conditions under certainty. As an investor, even though we have a considerable amount of foreknowledge, we don't know whether the economy is going to go into a recession or not. We know there is a probability that the economy will go into the recession. If it does go into a recession, our cash flow will be much lower than what it would be if the economy were to be in a booming position. So the fact is that we can predict what the future might be, but we don't know with certainty what it is actually going to be. That volatility part, the risk of that volatility is undertaken by the investor when you're dealing with ideal conditions of life. So coming back, your textbook then provides a couple of examples of present value accounting. It talks about reserve recognition accounting. So with reserve recognition accounting, it's an example of the application of present value accounting, and it specifically applies to companies that are in the oil and gas sector. So in the United States, the standard is referred to as Statement of Financial Accounting Standards 69, SFAS 69. And it was issued all the way back in 1982, so about 40 years ago. And what's required in the US is that companies, oil and gas companies in the United States, they have to provide disclosure for a dollar amount of the present value of how much they expect to recover from their proven oil and gas reserves, right? The amount of oil and gas reserves that the company has that have been proven geologically. And the whole point is to provide information that's perhaps more relevant to a person looking to invest into buying shares of the company. To make the numbers comparable across the board, the standard setters in the US decided to use a discount rate of 10%. All the companies in the US that report under SFAS 69, they have to use a discount rate of 10%. You might wonder, where did that 10% come from? Well, if the intent is to use the same yardstick for everyone, it doesn't matter whether you're using 10% or 8% or whatever. They came up with 10%, and 10% is what all companies must use. And they calculate the PV using the year-end oil and gas prices. That's what originally started. Since then, the Securities and Exchange Commission has required the use of 12-month average prices rather than using a price at a single point in time to smoothen out the effect of fluctuations in oil and gas prices. SEC mandates the use of average of 12-month prices. Now, the company has to explain how the present value was calculated, but you don't need any other disclosure about what the numbers depend on, etc. But it's pretty common for companies to provide additional disclosure on how they came up with the estimates. You may have seen something similar along the lines in Alberta when the provincial government comes up with budgets. They give you guidance about what the projected revenues, royalty revenues are going to be for the province, and they make assumptions such as what the crude oil price is going to be and how much of production they're estimating and so on. So stateside companies need to provide similar calculations for aiding potential investors. In Canada, we have a version of reserve recognition accounting, and that was when the Canadian Securities Administrators came up with National Instrument 51-101, and that was issued in 2003. Now, mind you, you don't have to memorize any of this, right? Someone was asking, do I need to remember all the dates and so on? You don't really need to memorize any of this because it'll be kind of stupid to ask questions. So this is just to give you a sense of whether anything along the lines of present value accounting is seen in real life. So this is an example of that. Okay, so in Canada, we have similar requirements, but the Canadian regulators, they made some changes with regards to how the numbers should be calculated. The disclosures need to include not only the proven reserves, but also probable reserves. So if an oil and gas company has additional reserves that have not yet been proven through geological means, but they are probable, i.e. they have there's a more than 50% chance of recovery, then in Canada, companies have to provide that additional bit of disclosure. And when they calculate the present value numbers, they have to not only do the 10% discount rate, which is the rate that they use in the US, but also they need you to do scenarios, right? So they need you to do scenarios using year-end prices, forecast prices, and then play around with sensitivity using a 5% discount rate, a 15% discount rate, 20% discount rate, undiscounted values. So the idea is to kind of give a sense of what the sensitivities will be to the amounts if interest rates were to change. And we've seen interest rates changed very quickly, right? From this time last year to where we are right now, interest rates have gone up very, very, very quickly and by quite a bit, right? So uh, you know that the impact on present value, if interest rates go up, the discount rate goes up, present value goes down, right? So for a party that's considering investing in oil and gas, with the higher interest rates, a higher discount rate would imply that the present value will be considerably lower. So an investor looking to make an investment today, as opposed to a year ago, will likely be willing to pay much less than what they were willing to pay for the stock a year ago, right? So that's kind of the rationale for requiring disclosure along many different A, price points, and B, different discount rates. They also, in Canada, the requirements also that any kind of reserve data has to be independently verified. And that can be a challenge in terms of just the costs. Bringing in an expert is not free. Costs a fair bit of money for companies to provide that kind of. So how successful has reserve recognition accounting been? You put it on paper, I guess no one will disagree with the thought that requiring companies to provide this kind of additional information to the investors brings more useful information. Great, sounds awesome. However, the reality is that as I mentioned, it costs money to bring in all kinds of useful users. And then you have issues about potential litigation. So in theory, there's better reliability for the Canadian numbers because they're supposed to be audited, etc. Now, if someone makes an investment decision based on such disclosure, and later on things go sour, whatever reason, there's a greater chance of lawsuits happening. So that, because there's the possibility of errors in doing estimations, and you're using forecast prices, which who knows how things will play out. Think about COVID. When COVID first hit, crude oil prices for a very brief period were actually in negative territory. Crude oil prices had plummeted, cratered. And so at that point in time, if you ask someone to forecast what the price would be in 2021 or 2022 or 2023, if someone said, oh, crude oil prices could hit $120 a barrel, or even right now, they're in the vicinity of $75 to $80 a barrel, people would have just said, that's impossible, because at that point, crude oil was trading, $10, $15 a barrel. Human beings don't do a good job of forecast, period. And even an honest mistake can result in people making bad investment decisions. And when people make an error, they need someone to blame, and that can result in loss. So that is the part that we have to be very, very careful with. When you look at the assumptions that they're making, in the US, using a 10% discount rate, that's assuming that the rate of return is constant at 10. That's never the case. Interest rates change all the time. It's impossible for us to look at all the possible things that can happen, right? So even as recently as a couple months ago, people were talking about demand destruction because COVID was resurfacing. The Chinese economy was going to be shut down massively. And what we're seeing is, well, China's pretty much reopened. oil prices have rebounded. We don't know how long it's going to last. So again, it would be a fool's game for us to try to predict what the crude oil prices are going to be in 2 months, 3 months down the line, let alone what they're going to be in the future. Too much of uncertainty. So one wonders how useful those numbers are. We don't have state probabilities that are objective enough. So the basic assumptions under which ideal conditions calculations can be performed are not met in real life. Right? Real life does not behave as if ideal conditions were in play. There's possibility of errors. You can put in a disclaimer saying, oh, our future estimates of future net revenues are not guaranteed to occur. But you know what? Investors, even after you have alarmed them or warned them, cautioned them about absence of reliability, at least investors from the US tend to be litigious. So lawsuits happen. You try to minimize the occurrence, but they will happen and just gets ugly, right? So people are, if you ask the users of reserve recognition accounting, they will typically give you a very mixed opinion about how useful those numbers are. And they take a fair bit of doing, right? They do take a fair bit of calculation to be performed. And certainly keep in mind the manager's reputation is important too. If a company provides numbers that are found to be patently not reliable, the reputation of the managers that run the company also takes a hit. And that can be nasty for the manager's future employment prospect. So that was one example. Reserve recognition accounting was one example of the use of present values. There's another example in your textbook from the world of insurance, and that's called embedded value. Embedded value is basically supplementary information that has to be provided by insurance companies. So here the amounts that the insurers provide would be the policy premiums that the insurers will be collecting, net of reserve requirements and income taxes, and actuarial assumptions used in terms of how long the parties to whom policies have been issued are expected to last. Insurance companies also get into the business of providing annuities for pensions and so on. And again, a lot of this information took a big hit when COVID hit, right? So insurers were massively hit. There was an expectation that the insurance companies would have to make massive payouts because of just the number of deaths, sheer number of deaths that occurred. Yes, they did take a beating, right, in terms of their stock prices, and they are recovering to a certain extent, but certainly have not recovered fully. There is a new IFRS standard on insurance. It's IFRS 17. Just in case you weren't aware of it, there have been changes to how insurance companies calculate revenues, right? So embedded value is another example of where there's a fair bit of present value calculations involved in the reporting. Now, if you were to compare historical cost accounting with current value accounting, you will have to look at it from the lens of relevance and reliability. Relevance, you need information to be relevant, right? That's what the IFRS conceptual framework tells you. Relevant information is helpful for assessing future cash flows of the company and to provide feedback value to users about what the predictions in the past were like. Reliability is, well, certainly not part of the conceptual framework for IFRS, but in ASPE and for the US GAAP, reliability is their other qualitative characteristic that they believe is very important. And reliable information is important from the point of view of assessing how good a job managers have been doing at preserving and appreciating shareholder value. Now, all that is great, but when you're faced with an environment that's constantly changing, there will be volatility. And volatility is just fluctuation. You'll have fluctuations in reported net income, you'll have fluctuations in stock prices, etc. So in order to make numbers more meaningful, there's always a push from the champions of relevance asking for more fair value numbers, more current value numbers. Now, current value numbers are definitely more relevant, but they are definitely affected by errors of estimation. So they tend to be less reliable. And so that's sort of a constant tussle. If you're using more current value numbers, you're providing more relevant information, whereas historical cost numbers are less relevant. Historical cost numbers, on the other hand, are more reliable as opposed to lower reliability for current value accounting. In terms of revenue recognition, if you're basing revenue numbers using current value numbers, you're likely being a little more aggressive with revenue recognition, but you are reporting numbers quickly. There is no lag with recognition. There's no need for any kind of matching of expenses to revenues if you're following current value accounting, whereas historical cost accounting requires that matching be achieved for numbers. The examples are really dated, to be honest. Enron was sort of the last example in a meaningful way that I remember of a company that used current value accounting even for revenue recognition. And Enron has been dead for almost 2 decades now. So again, accounting theory doesn't seem to change all that fast. Maybe at some point in time, we will do a deeper dive into Enron, what happened at Enron. But for now, just keep in mind that in a nutshell, if you're looking for more reliability, you want to use historical cost accounting numbers. If you're gunning for more relevance, you want more fair value information on your financial statements. We're looking at 732, and I can keep talking, but I think you folks might want a little bit of a breather. So what are your thoughts? Should we take a 10-minute break? Or should we go on for a little bit longer? Break would be nice. Okay. So let's go for 10 minutes. And when we come back, in terms of just general planning, we will probably call it a day at about 8:40-ish. So when we come back, there'll still be about 50, 55 minutes worth of discussion, some activity, but mostly it'll be, a bit of lecture coming from my end. My apologies. Initially, these things tend to be a bit lecture heavy, but as we move on, our chapters will become less reliant on lecture and we'll be doing more activities. So let's try and be back at about 7:43. We'll resume by 7:45. And if there's any question that comes to your mind, please type it in the chat box and I'll address it when we resume. So resuming after the break here, explain why true net income doesn't exist except under ideal conditions. So this is kind of the culmination of what I've been referring to. You don't have ideal conditions because the assumptions of ideal conditions are untenable. And this notion of one true net income number cannot be sustained except under ideal conditions. That's this last learning objective. So what's this about? A true net income does not exist except when you're dealing with ideal conditions. And the reason behind that is that in reality, we do not have state probabilities that are objective, that are not dependent on an individual's gut feel. And we are therefore not able to calculate true present value. So if you consider how a company comes up with a value in use, you might remember the term value in use for impairment tests. A value in use is by definition an amount that represents the present value of future cash flows from using an asset. And when a company tries to do that PV calculation, it has to, number one, estimate what the cash flows are going to be in the future. And secondly, it has to use a discount rate that would be reflective of not only the risk that the company faces today, but the risk that the company would be exposed to in future. That is impossible. That's just impossible. So in the absence of these truly objective state probabilities, and given the inability, our inability to compute true present values, the best thing that we can do is approximate net income as equaling the change in market values of assets. And when you try to do that, we run into trouble again because we don't have complete markets for all asset classes. There are certain assets for which we don't have readily available market values. So if you think about IFRS 13, fair values. If you have market prices available, go after that. If you don't have market prices available, then they say try to infer fair value by looking at valuations of other similar assets. Becomes a problem. Consider real estate. If you were to ask me, Harjinder, how much is your house worth? Well, my house, I can look at the City of Calgary assessment value, but that assessment was done in July of last year. A lot has changed since that time. So the number that the City of Calgary has sent me may not reflect the actual value of the house that I live in. I could call up a real estate agent and ask them, okay, what do you think is my house is worth? Now they would be able to look at the community that I'm in, the size of the house, other features in terms of, what, whether you have a walkout basement, et cetera, those kinds of things. And they'll come up with a number that would sort of reflect the average of the property values in the community. But does that necessarily mean that's how much my house is worth? No, not really. And therein lies the challenge even for companies. When you try to infer asset values by looking at amounts related to other similar assets, you're not really comparing the proverbial apples to apples. And then when you try to determine value in use as a net present value concept, good luck, right? There's so much of estimation error possible. So what can we do as accountants? The answer is a very cryptic, well, try to make financial statements more useful. What on earth do we mean by that? Therein lies, what is it that users need net income for? You answer that question, you'll be in good shape.